Hello, welcome to my channel today. This is King's Tutor. It's the first time of joining us. Thank you for joining us. Ensure you like, comment, share, and subscribe to my channel. Now, today we want to see a solution or a question regarding the hire purchase. Now, we have seen the introduction on hire purchase and also how to solve and how to post in the hirer's book, and also how to calculate interest. If you have not seen that video, I'll drop the link in the description, and also drop it up in this video so that you watch that before this, so that you can understand this. Okay, so we saw the introduction, and we said we can also record in two ways: in the book of the hirer and also in the book of the vendor. Now, I want to say a question on how to solve this. The question said, Delhi Tourist Service Limited purchased from Abiyama Limited a motor van on 1st April 2007, the cash price being 164,000 naira. The purchase was on hire purchase basis, 50,000 naira being paid on the signing of the contract, and thereafter 50,000 naira being paid annually on 31st March for 3 years. Interest was charged at 15% per annum. Depreciation was written off at a rate of 25% per annum on the reducing installment system. Delhi Tourist Service Limited closes its book every year on 31st March. Prepare the necessary ledger account in a book of Delhi Tourist Service Limited. Now, we've talked about this in our previous video. Now, we said to record in Delhi now, we have to check if Delhi is the buyer, that's the hirer or the vendor. We said Dory Self Limited purchase, it means he is the hirer. Okay, so it means you're recording this in the book of the hirer. Okay, so they said we should record in the necessary ledger. Now, we have seen the necessary ledger as regards the hire purchase contract, and we said it can be posted to one, the asset account; two, the hire purchase vendors account; three, the hire purchase interest account; four, provision with depreciation; five, depreciation account; and also the profit or loss account. Okay, so that's on that. Now, let's post as regards this. Let's post. But before we do that, we have to calculate the interest first. Okay, I said that in the previous video that the first thing you have to do is to calculate the interest. Okay, so we have to calculate the interest. So I said first calculate the interest. Okay, so we will calculate the interest. Now, they said from here the cash price being 164,000, and this is the amount of the asset. So if the hirer have this money, he can purchase outrightly. But if he doesn't have this money, it means that is when hire purchase comes in. But he has to pay 50,000 as initial deposits. We'll call that down payment. Okay, so he has to pay 50,000 as initial deposit. Now, whereby 50,000 will be paid at 3 years. Okay, now this 50,000 installments, there's an interest embedded in it. Okay, and they said the interest is at what, 15%. So it is the interest we want to calculate first, because it will be recorded in the book of accounts. So to calculate the interest first, we have to deduct how much was paid from the cash price. So we have first cash price, of the motor van. That's 164,000. 164,000. The next one is, say, less You can call it down payment or initial deposit. Down payment, because they said it paid 50,000. Okay, so for less 50,000 from this, we're going to have 164 minus 50,000 is 114,000. So is this 114,000 that is supposed to be paid on 3 installments, and which interest will be charged on it? Okay, so we're going to do on the first, we're going to add interest. So the interest to be charged on this is 15%. Interest on 114,000 at 15%. Okay, for the first year. So 50% on this. So we have 17,100 using the calculator. So if we add this plus this now, we'll have 131,100. Okay. So this is the new amount. Now they said he's going to pay 50,000 being paid annually on 31st March for 3 years. So let's less the first installment amount. So say less first installment amount of first less amount of first installment, that's 50,000 naira. So we have it's 1,100. Okay, so that's the first one. So we are going to calculate interest on this now. So we'll say add interest on it's 1,100 at 15% for the second year. Okay, for the second year, we'll have 12,165 using the calculator. So this now, if you add it now, it's 1,100 plus 12,165 will give us 93,265. Okay, so that's the amount you're supposed to pay. Now say less amount of second installment, which is 50,000. So this minus this will give us 43,265. Okay, now the last interest now will not be on this. So we said add interest for the third year. Now I made mention of this in the previous video. Now in this situation now, we don't need to calculate 15% on this again, since we know that they are supposed to pay the 50,000 at 3 installments, first, second. Now the third one, we're gonna get up an amount that will add up to this to give us 50,000. Okay, that will be the what, the third interest. So it will be 50,000 minus this. That will give us 6,000 735. Okay, such that when you add it together, it will give us the 50,000. Okay, so if you now less amount of third installment of 50,000, this minus this will give us dash. So this is actually how the payment and the interest will be. Okay, so in this now, we are going to calculate how we are going to post them, how it is to be posted. Okay, now in this now how it will to be posted involves the accounts that is necessary. I've said that before. So the first thing is, now when we have a cash price, when there's a cash price of the asset, we said two accounts are affected. The first account is the motor van account, that's the asset account, and the vendor account. Okay, the motor van account is to be debited, while the assets, the vendor account is to be credited with the amount. Okay, so they said on the 1st of April 2007. So in this now, on the 1st of April 2007, Abiama Limited, so it will be 2007 here, April 1, April 1, we have motor van. This is a cash price. Let me put it CP, the cash price. So the motor van, the money that was paid is 164,000 for the hire vendor, and the corresponding entry comes to the motor van account. Still 2007, April 1, call it Abiama Limited for the cash price of 164,000. Okay, 164,000. So the next is, they said the down payment was made. The down payment, as the purchase was on hire purchase, 50,000 being paid on sign of the contract. As initial deposit was made. Okay, so if initial deposit was made, payment was made, you credit the bank account and you debit the hire vendor's account. Okay, so we'll need the bank account. So there's a bank account, and the date is still 2007, April 1. April 1. So we'll write Abiama on down payment or deposit, whichever one. And the amount is 50,000. Okay. While the corresponding entry comes to Abiama, seal 2007. 2007, April 1, is coming from bank as down payment, 50,000. Okay, so when they've made this down payment, other money now will not be the instrumental payment that comprise of the interest, where the interest is embedded inside. Okay, so we are going to record the we're going to record the instrumental payment They say 50,000 being paid annually on 31st March for 3 years. Okay, so as they pay this instrumental payment interest, so we're gonna record the payment, and as we record, when the instrumental payment is made, you credit the bank and you debit the hire vendor's account, okay, with the amount that is paid. Then the interest that is embedded in it, you credit the hire vendor's account and you debit the interest account. So we're going to be doing that one after the other. So for the first payment that was made after 2007, the next year is the other year, which is 2008. Okay, so it will be 2008, March 31st, because they say they are ending every year at March 31st. So March 31st, Abiama, that's for instrumental payment, which is how much? 50,000. Okay, so since it is 50,000, then we'll come here, 2008, March 31st, bank, as 50,000. Okay, so since it is 50,000, they've received. Now the interest that was embedded there will be shown here. You credit the higher vendor's account and you debit the interest account. So we also have for interest. So the interest for the first year is 17,100. Okay, so we're gonna have it here in that same year, 2008. When they are paying this money for installment, that is when the interest also is being paid together. So we'll have March 31st, interest account. The first interest was 17,100. Okay, so if we add them together, this plus this will give us 181,100. 181,100. This is 100,000. So there'll be balance here, which becomes our balance carried down as 81,100. So that when we add them together, it gives us 181,100. Okay, so since this is March 31st, the corresponding entry comes here as, so it should be April 1st, balance brought down 81,100. Okay, now if you watch here, we said the interest is 71,100. So the corresponding entry comes to the interest account. So it is March 31st here. So this is still 2008. March 31st is coming from Abiama, 17,100. Okay, so that's the first one. Now, when the second installment is being paid, it is still the same process. So this one will not be 2009, March 31st, being paid to Abiama, still installment, 50,000. Okay, so 50,000. So corresponding entry comes here, 2009, 2009, March 31st, bank as 50,000. Okay, so Now, if it is 2009 there, it means that is when, as March 31st, that is when they will pay the interest. So, the interest. So, the interest now for the second year is 12,165. Okay. So, we have 12,165. So, I'll add them together. We'll have 93,265. 93,265. So when you have your balance, so we'll have a balance carried down so that these two will be the same. 93,265 minus 50,000 to give us 43,265. Okay, so at this point now, we'll now have here 2009 April 1st. Our balance brought down 43,265. Okay. Now also in the interest account, remember for the second year, so we'll have here 2009 March 31st. It's coming from Abiama, which is 12,165. Okay. That's for the second one. Now the third installment, because they said it's for 3 years. Now the third installment will now be 2010. Okay. 2010 March 31st. That's from the bank. That's Abiama, which is installment. The amount is 50,000. So it is coming here at 2010 March 31st. It's receiving from the bank. Okay. At 50,000. Okay. So now the same year they paid interest 2010. So they paid interest as at 31st. Now the interest we said is one that is necessary. Okay, the interest account. Now this is the third installment for the interest. The third is 6,735. So we have here 6,735. Okay, so that when we add together, this is 50,000. And this is also 50,000. There's no balance again. It has balanced itself. Okay. Now we now remember our interest for the third year. So we have to replicate it here also. 2010 March 31st Abiama as 6,735. Okay, so that is for the Abiama and the bank. Now, once we have recorded the interest account, the next thing is to close it to a profit or loss account. Okay, we said that I will close the interest account to the profit or loss account. Okay, so if we do that, so we'll close it the same year. This is 2008. So we'll close it. Now these ones are already closed. So we'll close the interest account to the profit or loss. So we'll have here the same date, March 31st, profit or loss account 17.1. The next one we have 2009 March 31st, profit or loss account 12,165. The next one we have 2010 March 31st, we have profit or loss account 6,735. So closes. Okay. Now the corresponding entry will now come to the profit or loss account the way it is here. So we have 2008, 2008, 2008. We have profit or loss account here. So we have here March 31st, interest account 17,100. Okay. And next year, 2009, we have March 31st, interest account 12,165. 12,165. The third one, 2010, March 31st. We have interest account 6735. Okay, so that's the closing of the interest account. Now the next one is the depreciation and the motor van. How to record that. Now if you check here in this question, they said depreciation was written off at 25% per annum on reducing balance system. Okay, reducing balance, not on straight line. Okay, so and in the depreciation procedure, we credit the asset account and we debit the depreciation account with the amount of depreciation. Okay, so from this now, if you watch here, we have the cash price that was recorded before for the motor van, the asset account. Okay, so we're going to record the depreciation at 25% per annum. So it will not be done. This is where they bought it. So the depreciation should be 1 year after. So it will be at 2008 at March 31st. Okay, so we'll have depreciation. That's 25%. That's 25 over 100 times the cost of the asset, 164,000. So this will give us 41,000. 41,000. Okay. So to balance it, to make the two balance, so we have our balance carried down as 123,000. So that when you add these two, this will give you 164,000. And this will give you 164,000. Okay. So that's the depreciation for this. So the corresponding entry will come to the depreciation account. So we'll have here 2000 2008. Okay, so we'll have 2008. We'll have here 2008, March 31st. It's coming from motor van. Motor van. How much is it? 41,000. 41,000. That's all. Okay, so the balance here we brought down here. So we have 2008 April 1st. Balance brought down of 123,000. Now it is not straight line, it's a reduced balance. It is on what? The reduced balance. So we'll start again. So it will now be 2009 now, March 31st, the next year for the depreciation. So depreciation will be 25% on this balance. Had it be the straight line, it will be on the cost. Okay. but now it will be on the reduced balance. So 25% on this will give us 30,750. Okay. So to balance this up now, we will now have a balance carried down. This minus this will give us 92,250. So that when you add them together, you have 123,000. 123,000. Okay, so at this point now, once it is 30,750 here, the corresponding entry comes here in 2009, March 31st in depreciation. So you have motor van 30,750. Okay, so the third one will have a balance brought down here 2009 April 1st. We have balance brought down 92,250. So our depreciation will now be in the next year, 2010, March 31st. We'll have depreciation on the reduced balance. So it will now be 25% on this now, 92,250. Okay, so 25% on that will give us 23,063. So to get the balance carried down, so it is this minus this. So it will be 69,187. So once we add it, it's supposed to give us 92,250. So that this will be 92,250. Now for the depreciation account also for 2010, March 31st. So we have here 23,063. So we have motor van 23,063. Okay. Now this balance carried down. Now in 2010 April 1st, the balance of the assets, the new book value of the assets will now be 69,187. Okay, as the value of the asset for the third year. So we've got the depreciation also for the third year. We have to close the depreciation to the profit or loss account. Okay, because the depreciation is close to the profit or loss account. So we'll close 2008 here, March 31st. We have motor van. We have profit or loss account. Profit or loss 41,000. The next one, 2009, March 31st. We have profit or loss 30,750. The next one, 2010, March 31st. You have profit or loss 23,063. Close it. So this now depreciation is posted to the profit or loss account. So it's now posted here. The same date for 31st. So this will now be for depreciation 41,000. So when you add them together, you have 58,100 for 2008 for the total for profit or loss account. For 2009, bring what you have here to be depreciation. You have 30,750. So when you add them, you have 42,915. Okay. Now the third one, you have this. So at 31st, you have depreciation. That's 23,063. So when you add them together, you have 29,798. Okay. I have 29,000, the depreciation from here. So when you add them with this, you have 29,798. Okay. So with that, we have solved the what question. Okay. So the question said we should prepare in the necessary ledger. We calculated the interest first, calculated the interest, after which we posted the cash price, debited the motor van account, created Abiama ledger, where after the first installment deposit was paid, we credited this down payment and debited this. The installment, we credited all this and debited this. Then for the depreciation, we have to record the depreciation at reducing balance method, which the corresponding entry comes to the word depreciation. We close the depreciation and interest account to profit or loss account, which they are now posted from the profit or loss account. We are now posting from the individual account to the profit or loss account. Okay, so this is how to prepare in the book of the higher purchase. We are going to see other examples. So if this is the first time of joining us, ensure you like, comment, and share. Subscribe to this channel so you don't miss anything as regards accounting, financial management, and all things regarding to calculation on this channel. Ensure you like, comment the aspect you want. Okay. Thank you very much.